Okay, we'll get started now. Welcome everyone, and welcome to part 5 of a masterclass with M&A game changer Dino Lucarelli. My name is Zach Strobel. I work at the NKU Entrepreneurship Through Acquisition program in partnership with Barnes Denning to put on this series. And just real quick, our Entrepreneurship Through Acquisition program, what we do is we provide all of the essential elements needed to prepare, acquire, and grow a small business. Just a couple reminders about this session. If you are going for the CPE credit, make sure that you respond to the poll questions that you will see throughout the seminar. And then also, you will see some information in the chat that will be provided by Barnes Denning. So just pay attention to that as well. And then as you have questions throughout the presentation, make sure you type them into the chat and Dino will address them during the Q&A session. And without further ado, here's our speaker, Dino Lucarelli.
Okay, thanks, Zach. Welcome again. This is number 5 of a 6-part series of mergers and acquisitions, a how-to session. So today we'll talk about financing or funding your acquisition. And we're going to go a little bit different today. We have a presentation that I hope you find both informative as well as a little bit lighthearted. But this is pretty serious stuff, but it's dry, and a lot of the content we've covered is dry, so we'll try to spice it up a little bit. Okay, funding and business acquisition. There's a bit of delay in these slides, so if you can go ahead and advance the slide, Kat. Okay, so you need money to acquire a very business, and you're not sure how to go about it. Okay, so you're at that point. You need to get moving. Okay, so what do you do? You have to be investable. So let's talk about what that means. If you think back to the first session of this program, we talked about attributes of high value businesses, how to, if you're a seller, prepare your business for sale, what the attributes need to be, and if you're a buyer, what to look for. Well, this is a similar theme here. And some of these are the same that we've covered already. But to be investable, you as a buyer need to be seen as a very strong organization or entity by your bank or your financing partner. The first thing is that you have to be invested yourself. It's what they call skin in the game. So you want to buy a company, you are expected to put up some of your own capital. There was a time back in the 90s when there were acquisitions getting done with essentially no money down. It was a crazy time, and that resulted, as you can remember, in the crash of 2008. That was one of the things that happened, is acquisitions had been funded with no money down. And so you have to have skin in the game. You're going to have to come up with 10, 15, 20% of the value of your company. You have to have a 3-year detailed plan. It should be realistic and easy to understand. I can tell you through lots of experiences that I've worked with companies or organizations that are looking to buy, and we're talking to the target company, and the seller says, well, I don't know exactly what we're going to do next year or 2 years out. I don't really, and that's not a good place to be. And if you as the buyer cannot convince your banking and financing partners that you have a plan and you have backing to support that plan, and you have data points, whether it's through research houses or whether it's through some sort of trend analysis. Remember session 1, we talked about looking at backlog and pipeline reports and trying to draw some trend analysis from that. Your 3-year financial plan needs to be well done, and it needs to be done with an income statement, a balance sheet, and a cash flow statement. A lot of people think that a financial plan is a profit and loss statement where you grow revenues by 15% and everything looks great and rosy. Well, that's not really true. And the banking community and the financing partners, equity partners, whatever, sponsors, you will blow your credibility if you don't do a serious 3-year plan and take it all the way through cash flow, where people can see, here's the debt payments that are coming out. Here's the cash flow that's left. Here's our cushion. And then you can sensitize it and say, what if we had 80% of our plan? What if we had 90% of our plan? But your 3-year plan, and this is where I would say experience is the best teacher. Some people say, well, we'll go super conservative, put a plan out there, you're going to beat. Well, that may disadvantage you. If you go super conservative and the bank thinks that this is a middle of the road forecast, you may not get the credit you need. So what we like to do is we like to go to what we feel is the base case. This is our most likely scenario. It's neither aggressive nor conservative. It's our closest to the pin. Now, if we want to sensitize it and say, let's take, what if we hit 85% of it? That would be our low case. That's a good way to do it. So you've set a range for your financing partners to see that even if you fall within that range, you're still a financially stable, solvent organization. And it needs to be easy to understand. And it's not just numbers. There's characteristics of key performance indicators and growth rates, et cetera, that you factored in. And so you have pretty easy to understand assumptions. So you don't just throw numbers out there and leave the banker to have to figure it out. Collateral. It's very helpful if you have collateral in your business. Now, hard collateral, such as brick and mortar, inventory, et cetera, is important. But there's also, and I'm going to extend this out to say, what are your intangible assets that you bring? What is your secret sauce that you bring? It's important to be able to demonstrate that, why your company's valuable and what it has to offer that will cause the financing to be stable and supported. Within the collateral realm, I just sort of harken back to many of you who have financial backgrounds. If you remember back in college, we talked about the 5 C's of credit. Bankers think of it all the time. And the 5 C's of credit are character, which really refers to, is your credit good as a company or as an individual? Collateral, do you have collateral to support it? Capital, how much capital are you willing to put in? And are you willing to put in a significant amount of your own money? Because the more you're willing to put in, the safer the bank is, or your other equity partner. Capacity, so how much capacity to take on debt does your company have? And then the conditions, like what exactly is the money going to be used for? And is it going to be safe? Is it going to be taken care of? Are there covenants, et cetera? Okay, so then visibility to revenues. We talked earlier in week 1. You should be able to forecast out over the next 12 months what you think you're going to get. I was actually working with a company at one point, and it wasn't the only time it happened, but I was talking to the owner, and he was selling some high-end automation equipment for factories. So electronic arms and electronic eyes and things, that pretty sophisticated things. And he was doing about $5 million in revenue. And we were talking about his next year forecast because he needed some additional capital from his bank. And I said, let's put together their forecast. What do you think? Where are we going to go next year? Let's think about this. He's like, I have no idea. And that cannot be the answer. If the answer is, I have no idea, then if you have no idea, your bank isn't going to feel comfortable with that. So you really have to have visibility revenues. You have to be able to demonstrate through some trend analysis or whatever, what your revenues are likely to be and why you believe that's true and why the bank should bet on you. You should have a great team. We've talked about this before. Really strong organization chart. You should have a product or service superiority. Now, as a buyer, you're ferreting these things out for yourself so that you make sure that what you're buying with your own equity money has these characteristics, but the bank wants the same thing. Because if you buy a company with 2/3 or 3/4 of the purchase is bank money and 1/3 or 1/4 is yours, they have more skin in the game than you do. So it's really important, not just to you, but to them, that you can demonstrate you have a better mousetrap. Strong IT infrastructure. This is relevant to the financing partners because they want to make sure that you have access to timely data, that you are tracking your business and you have good information systems. So not just from an operational perspective, but you can pull together financials very quickly and you can pull them together consistently. This is super, super important. Banks get very concerned when a buyer doesn't have good IT infrastructure, can't produce financial statements within the first 8 or 10 days of the following period. So very important to have this and be able to demonstrate that you have that. If you don't have that, then as a buyer, you're going to be needing to make assertions to the bank that you will implement a strong IT and information reporting structure so that you can provide timely information to the bank. Clearly defined job roles and responsibilities. Oftentimes, when people buy companies, the CEO is retiring, and that CEO may be heavily involved in the day-to-day operations. Recently, I was working on a deal where the CEO was a 35-year guy. He was an engineer, but he was super creative, and he very much created the product set and the equipment upon which the product was built, and he was all the way in. And so if you don't have somebody to replace him or her, and you don't have his commitment to stay on for a significant period of time, you're going to have difficulty in getting financing because you've got a hole in the organization. So it's real important in the due diligence to identify what holes you will have and come up with plans to remedy. I've actually seen transactions held up because the owners were departing and there was a search being done by the buyer for an operations person to replace that person. And we had a deal last year that got held up for like, I'll say 90 days while we identified a new chief operating officer. And it ultimately closed, but nobody was interested in having the owners walk away and have a gigantic gaping talent hole in the organization. Consistent, predictable cash flows. Clearly, anybody who's lending you money or giving you equity money will want to know that you can have a good profit, good cash flow, and that you're going to be able to sustain yourself. So again, this is a bit of a repeat from the week one. Contingency plan if things go awry. This is really important. So what oftentimes people will go into businesses and they'll put together a plan. Now, this is our plan, right? This is, well, what if it goes wrong? Particularly in the world of COVID, I don't think any of us legitimately saw COVID coming. But what if things happen? What if we hit 50% of our revenue? What's our contingency plan? And a contingency plan would include, okay, so if things start going wrong, here's the specific action steps we will take to maintain profitability. And it can be things like, oh, we will renegotiate our rents. We will cut our 401k contributions. We will eliminate a product line, or we'll sell a piece of real estate. And it's important to have that contingency plan way before you need it. Because when your financing partners are looking to give you money and everything's rosy, they want to know that you've thought ahead. I was working with a CFO in the last 2 weeks, and he's a newly appointed CFO, a young man, very talented, and he had presented his 2021 plan to his board. And what I said, or he had prepared it and was going over it with me, and I was helping him fine tune it. And I said, do you have a contingency plan? And he said, no. And I said, well, then you will rightly be called out by your board for not going as far as you need to go. You need to be able to say, we'll pull these levers if things start to go wrong. We can't wait till we're 6 months into the year and sales are down 40% to start firing entire staffs of people. That may be part of a contingency plan to do reductions in force in a predicted, planned way, but not knee-jerk reaction. And then financial partners love to have an advisory board or an outside board of directors to oversee companies. When organizations lend money to other organizations, they want to make sure that somebody is watching it closely. We are right now, our firm has been retained to oversee a particular company's use of a line of credit that's been established because the company is struggling through COVID. And the bank reached out to us and said, if we lend these guys additional money, would you be willing to oversee it? Now, we're not an advisory board, but we're an outside party that's keeping score. And so if you can claim the majority of these characteristics, then you're investable. And if you can't, you have a problem. Okay, let's go to the next slide. So you don't want to be this guy. That guy's not real investable. You don't want to be that guy either. He doesn't look real investable either. So you want to be investable. So I like this slide because it says a lot. My wife, I would refer to her as the queen of dinner parties. And what I can tell you is when we have a dinner party planned, she's 2 weeks out when she starts preparing. We're talking about painting areas that haven't been painted, putting in new carpeting, all new china, sometimes new furniture, because she wants to put the best foot forward. That's exactly how you want to be in your business. Put your best foot forward. It's kind of interesting. I remember long ago a TV show. I think it was L.A. Law, and Edward Asner, the guy Lou Grant was on, and he was a big dollar investor, and he was talking to one of the lawyers, and the lawyer was in jeans on a Friday, and he said, "Well, it's Casual Friday." And the Lou Grant character, big money guy, said, "Well, you know, you're handling my money. I don't want you to be casual with my money. I want you to be formal and serious." And that's really the way it works in buying a company as well. Your financing partners want you to be daggone serious. They want you to be as committed as possible to putting your best foot forward and keeping your best foot forward. They want you to make sure that your organization is tight, it's crisp, it's well done, it's well organized, it's well orchestrated. That's investable. Just like this dinner party table is investable. Next. Okay, now there's Zach. I'm sure we're trying to get the next slide up. We'll just wait. Okay. It's not investable, right? That doesn't look good. I'm not lending money to that guy. That place is a mess. Okay. So how do you get the money? For most acquisitions, I'll say of 50 million and under, you're talking about banks being the primary source of funding. And banks, commercial banks, are more risk averse than equity investors. So they're going to be first in line if a deal goes south. But because they're first in line, they have priority. They offer the lowest cost capital to most companies. So that's a good thing. So the first place we go is to the commercial lending world. And so that's where you're going to get the bulk. Now, equity that can have advantages over debt, because equity, you can say, well, we're not going to pay dividends until we have X dollars cash flow, or we have X dollars of a war chest built up, whatever. So your equity holders tend to be more patient. Your bank wants to get payments monthly, beginning right away. So while equity can have advantages, it's more costly. So the equity holders are lower down the food chain in terms of claims to assets if things go wrong. So the equity holders are going to want 15, 18, 20% at some point, whether it's through a combination of dividends and or accretive value on the equity or cash out value. But the equity holders will want a higher return. So it's a bit of a balancing act as to how much debt and how much equity. I would say that for most small companies or most organizations that are looking to acquire, a debt to equity ratio of 2 to 1 or 3 to 1 is not uncommon. And that will give you the lowest overall cost of cost of capital. The issue with that, though, is the debt service, and you want to make sure that you can cover the debt service and that you have enough cash flow to make that happen. And when I say sometimes you need a blend of equity and bank financing, almost always you need that. But most of the equity can come from you or your company as the primary owner, but sometimes you need another slug. And I want to talk about that for a minute. There's this mezzanine financing that many of you may have heard about. Mezzanine financing, so if you think about the right side of a balance sheet, you have the senior debt, which is first in line. That's That's the first guy, if things go wrong, to get paid and to get paid out. Then you have at the bottom, you have the equity holder. And the equity holder is going to get, a bigger return, hopefully, in exchange for taking that bigger risk. But there, in the middle of those two, there's what's called a mezzanine group. And a mezzanine group is a mezzanine facility is typically an uncollateralized loan that is made by a private equity firm or a mezzanine firm. And the mezzanine facility will have, sometimes it has different features. So let's take a typical mezzanine loan. It may be, so let's say you borrowed 80% of the collateral in a company on a senior note, and you put as much as you can put in, and you're $1 million short. So you would have, and I'm looking at right now on the screen is a picture of Zach. I don't know if that's what everybody else sees, but if you could put the slide back up. But anyway, the mezzanine facility could have certain features, like maybe it's interest only for 2 years. So think of it as a loan with an equity component. And the loan with the equity component is, so it could be, let's say it's a 5-year note with interest only for the first 2 years, and then it begins amortizing. And it will often have, as an additional kicker, warrants that are issued, equity warrants that are issued to the mezzanine firm. A warrant is a stock option issued to an outside party. So when you think of golden handcuffs, people, CEOs and C-level executives getting stock options from companies. A stock option is a right to buy an equity at a stated price. So if you're issued the stock option when the stock was selling at $20, when the stock is selling at $45, you've got a $25 equity balance in that option. So you're considered to be in the money. A warrant's the same thing. So you have this important, and in the last 20 years, emergent capital source called mezzanine financing. And typically mezzanine will be at least $1 million, sometimes more than that. Mezzanine lenders don't like to do little small loans of $500,000 or $750,000. Even $1 million tends to be on the small side, but it's an important additional source when you run low on collateral, or when you don't have enough collateral, and or when you don't have enough equity yourself in your company. And so it can be a very important slug of capital to help you get to the next level. Okay, next slide. Okay, so how much can you get? Always a question we're going to ask. How much do I have to put in? How much can I borrow? I got that question today, actually. Okay, go ahead. Well, that obviously is not the answer. There are limits, and it's not this complicated, but there's a fair amount of calculations that need to go into it. I will tell you that there are 2 guidelines we'll get to. You can move to the next slide. Yeah, it's harder than this, obviously. There are 2, I'll say, guardrails that we want to put up that will essentially govern how much you can get. The first is a debt to equity ratio. Most commercial banks aren't going to lend more than 70 to 75% of the acquisition price. They just are not. So you're looking at, on the high end, a 3 to 1, 3.5 to 1 debt to equity ratio. That's one guardrail. Another guardrail is the debt to EBITDA calculation. EBITDA is earnings before interest, taxes, depreciation, amortization. And so the banks will often go 2.5 to 3 times EBITDA. So think of 3 to 1 debt to equity and 3 to 1 debt to EBITDA. That's sort of going to be the upper end of how much you can borrow from a commercial lender. Now these numbers move around a little bit as the economy has fits and starts, but much beyond that, you're unless you're in a very specialized industry, you would expect to be governed by those upper limits on debt financing. And so some rough rules of thumb is banks are going to want collateral, or it's inventory, equipment, real estate, customer AR. They're also going to want, banks are also going to want to see what is your secret sauce. Now, we did a deal, I did a deal in late 2018, and it was a software company, and it was software as a service. And what the company did is it provided online portal for companies to evaluate their people. So let's say that you have your managers going in and filling out evaluations online, and then you have the associates doing their self-appraisal. And this software solution was housed that information and made it available through dashboards and reporting to senior executives for compensation management and personnel development. So, but that was a form of collateral as well, because it was a very robust package that worked, that the company felt like, even though it's not hard collateral, it's still collateral. And in that case, though, they wanted to know that the intellectual property that was behind that was something that was going to continue to generate income. And of course, we were able to get the deal done, but we went SBA because it wasn't hard collateral. So banks will generally lend 70-80% of the collateral, subject to cash flow and repayment ability. And there's different kinds of loans. There's term loans, and this would be your typical acquisition loan. It's a $5 million deal. We're going to borrow $3.5 million from the bank and put $1.5 million of our own money in. And they go from 3 to 10 years. Typically, acquisition loans are right now, they're in what we call a 5-10. So 5-year term with a 10-year amortization schedule. So you would essentially be making payments as if it was a 10-year loan, but at the end of the 5th year, you have to either have a balloon payment, or you would be making a refinance and re-borrow the outstanding balance. And that could be for acquisitions and equipment purchases, or combination of those. And then we have working capital lines of credit, which are generally interest only, renewable 1-year loans used to finance inventory and cover current period costs. So let me be clear about this. Banks will lend you money on a term loan, and they will also, in an acquisition, give you a working capital line, but they don't want you using the working capital line to finance the purchase. So let's say that you say, I'm doing a $5 million acquisition and I need $4 million to put to my $1 million capital. And so the bank says, well, we'll be willing to lend you 75% of that. So $3,750,000, and we'll give you a working capital line of $500,000, but we don't want you putting any of that working capital towards the purchase. They just don't like it, because the working capital line has a specific need in the context of running your business, which is to finance inventory and receivables. And so if you don't have enough collateral in your business, it's not a usual circumstance to turn to a working capital line and say, well, I'll take some permanent working capital against that line and use that for the acquisition, because the banks want those to be 1-year renewable, and they only want to give you, typically, they want to limit the amount of the working capital line to something like 75 to 80% of the collateral that covers. So if you have receivables of $1 million, the bank may say, well, look, we'll be willing to advance you $750,000 on your working capital line against that $1 million in receivables, because we know that, you're going to be getting the cash flow. But if you said, well, no, we're short $300,000 on our acquisition too, so they're not going to give you a full $1 million or more than $1 million when your collateral doesn't secure their investment. There are installment loans you can do, and you can expect to pay for all the types of financing up top 4 to 6% for this financing. Maybe a little bit better. Prime rate's 3.25%, but expect to pay 4 to 6%. Now, we did a deal where we actually had a term loan, we had a working capital line we established, and we went to it was actually a vehicle-based company. We actually went to a leasing company, and we leased a bunch of new equipment on term leases. And so we used 3 different types of financing, but the working capital was specific to lines to the AR and inventory. but there are different ways that you can structure your debt to get where you need to get. Okay, next. Okay. Now, this is more for ongoing companies, but now this is if you start to get into real difficult straits. Finance companies will offer purchase order financing and factoring of accounts receivables if needed, and the rates can approach 20%. This is sort of a last ditch type of financing. If let's say that you came up with a really cool product and it's in development, and you need financing, and you've got orders from committed buyers. So you're in the production phase of a product and you don't have enough capital to get it done. You can do what's called purchase order financing, where you will be advanced money against those purchase orders, and then those receivables are collected when the sale is made, and the money is sent to you directly from a factoring company, but they're going to charge you 20% or more in those rates. So I've seen it done, and I've seen companies work through it. I've seen it, and it can be an important source of financing, but it's not used in the context of acquisitions. Equipment leasing can be important. Again, we did a deal where the equipment was outdated and we needed new equipment, and we couldn't get the bank to finance the old equipment because it was just most of it was junk. So we were able to go out to a financing company and get them to buy it back, the old stuff, and put money in, and then lease back new stuff to us, which essentially eliminated the need to borrow that money for the acquisition. So, but equipment leasing companies are out there, and they're usually going to be a couple points higher than bank rates, but it's still good money, and it can be an important part of your acquisition strategy. Equity investors will need to trust you and believe your story. Now, I talk about angel investors here in private equity, mezzanine. We talk about mezzanine. This whole notion of angel investors, and I'll give you one person's opinion. I know there are angel investor groups out there in the community, and I've been in front of these groups. Angel investors tend to be high net worth individuals or groups who want to pool their money into investments. It can be a very rigorous process, and the angel investor community can be very difficult to work with. It's what you have is, let's say you have 10 angel investors in the room, and one person asks a question that causes 9 other people to be uncomfortable. Now you have 10 people that all have a concern, and then the next person asks a question. Now the other 9 people have that concern. I would say angel investors is a tough way to go. It's a tough row to hoe, but I've seen it done. I also would say if you can get an individual angel investor, to somebody that knows the space or has had success in the space, a high net worth individual who is wants to be benevolent and likes a nice return, that can be a good source. But the idea of angel investor groups, I've struggled mightily to get deals done by angel investor groups. The story that you tell, it really needs to be a good story. It needs to be a story that is believable, and again, it's credible. It's one that you can say, you know, I got my information from XYZ First Research Report, and they forecast growth in the agriculture business, the one that we're in, and here's the report. It's, you know, when it's, hey, trust me, I know what I'm talking about. That's tough. That's difficult. Bankers, rightfully so, if they're going to have a significant investment in your business and you're buying the business and you're new to the business, they want you to be able to demonstrate competence in being able to stand behind the numbers. Now, a lot of these equity investors will want, well, in this environment, more than 10%, but minimum 10%, but usually looking for 20 to 20+% return. but they may be patient, you know? And so that's the good news about an equity investor versus just a standard traditional senior lender. But usually their window's relatively short. Now there's different, you know, there are a few absolutes in anything. And so, but I would say that typical mezzanine deal is 3 to 5 years. And at the end of the 5th year, they want to be out. And what they want to do is they want you to pay back the principal on the note and cash out their equity, their warrants, so that they're made whole. And it can go longer. There are some equity groups that have a 7-10 year hold, and there are some family offices that will say ours is a complete buy and hold strategy. Once we're in, we want to stay in, and we want to run the company for as long as we can run it, as long as the management wants to stay. We want to ride it out with them. So there's not a one size fits all here. And so I would encourage you not to get stuck into that trick bag. Okay. Okay. So what you need to show. I'll give you, I was very complimented a few years back. I presented a financial package to a bank on behalf of one of our clients, and we were buying real estate, we were buying equipment, and we were getting a working capital line, and we're getting a term loan, and it was about $3.5 million, and we submitted the package, and the banker came back and said, this is the first loan we've ever done that we did not have any questions from the underwriter. And that's the only time that's ever happened to me either. So it's not bragging, it's just saying you want to come strong. So if you are looking to finance with anybody, you're going to need the last 3 years of business and personal tax returns, last 3 years of internal financial statements, which includes income statements, balance sheets, and cash flows, 3 years of projections, a written use of the money, and a written plan proving that you're investable. And that's so important, because so think about it this way. The people that you're talking to at the bank generally are not making the decision. The people you're talking to at the bank are out in the field canvassing to try to bring in likely good credits. And so they bring this in and they have to present it to the management team, the credit committee, and the underwriters, and they have to tell your story. Well, who's better to tell your story than you? And so if you don't want to write a business plan that talks about, your future prospects, your customer mix, why your product is superior, what you see as growth, the strength of your internal team, the competitive landscape, if you don't want to do that, you're leaving those details up for grabs to supposition and to the fearfulness of the bank credit people. Why would you want to do that? Why wouldn't you want to write with your pen, your story in your words, so that you can, again, put your best foot forward and be investable? So you want to have all these things. And very important, you need to have a guard dog to make sure that the investors are safe. I was fortunate enough to help start up a company about 8 years ago, and we had a strong operator who had 20 years in the business, and he wanted to start his own business. And so I was asked to help him raise capital and go out to the community and also secure some lines of credit. And the thing was, it's a startup. It's a totally new entity, and it was very capital intensive, heavy capital intensive. And what the investor wanted and what the bank wanted was a guard dog to make sure that this very strong operator it was a specialized construction company, and we had an investor that parked several $100,000, and then we had a bank that opened up a line of credit for about $700,000. And then we went to an equipment leasing company, and the equipment leasing company authorized something in the neighborhood of $1 million in credit to buy big bucket trucks. So we capitalized that thing with almost $2 million, but all of those credit issuers were very concerned about who's minding the store. And so a lot of people want to go into business or buy a business, but don't have the financial background that will give confidence to the lenders. So, if you are an entrepreneur and or a business that is acquisitive, one of the first questions they're going to ask is, how strong is your back office? How strong is your CFO? Do they understand how to do financial planning? Do they understand how to run the amortization tables? Do they know how to track, 13, 26, 52-week cash flows? Do they have a contingency plan in the event that things go a little bit wrong? This guard dog mentality is super critical to the go forward posture of the banks and any of your financial partners. Okay. So what else? Really interesting. It's really interesting how many companies do not produce monthly financial statements. If you want to be a company that is investable, and if you want to be able to have a good relationship where you need more money, you go back to the bank and they're going to process you quickly. You should be running financial plans monthly, and you should be producing monthly financial statements versus plan to be accountable to your money source. It's so interesting. When I go into a lot of companies, I will say, so who's your banker? Oh, it's, whatever. Okay, maybe it's Huntington. And so your banker's Huntington. When's the last time you saw your banker? Well, I don't call them unless they call me. Why not? My view of the world has always been, even if the news isn't great, if you're giving them the information that they can use so that they don't get blindsided, you're going to be in better stead. And if the news is pretty good, or if you're tracking to your plan, keeping your banker apprised is so important. And if the bank believes that you have the wherewithal to do that, they're going to lend you money. And if they think you don't have the wherewithal to do that, and you have, Aunt Sally is doing our accounting, they're going to look at that as a negative. They're going to feel like, wow, are we going to have to wait for an annual tax return before we see how our money's doing? So you should expect to have a plan done. You should expect to do monthly financial statements, and variances to plan. And if you have variances to plan, it can't be, sales were down 20%. Okay, that's a fact. We need to understand what that means going forward. How do we roll that into next month and next quarter and next year? What does that mean for us? Is that a temporary blip? Did we have, our sales team fell asleep the last week of the month, or what happened? Because if you can't explain it, in the absence of a reasonable explanation of negative things, people are going to think the worst. And if you have investors, equity investors, they're going to be climbing all over you, wanting to know what the heck's going on and what's your plan and what's the remedy and why did this happen? So that's really important. And it's amazing how many companies are not doing this. So if you're not doing it and you want to be an acquiring firm going forward, you need to have a robust financial back office that can produce monthly plans and monthly actuals to plan variances and written narratives. The next bullet, expect to have personal guarantee. So it's so funny how many people will say to me at the inception, so we're going to do an acquisition search. And it's amazing how people will say, I'll probably, not as much now, probably 1 out of 5 new clients will come in and say, well, I'm not signing personally on the note. And I'm saying, well, then you're going to do 100% equity financing, right? Because if you're not willing to sign and guarantee the loan, why in the world would the bank lend you money? You expect the bank to take a risk on you that you're not willing to take on yourself. This sounds ridiculous. It sounds crazy, or I don't know. Is that really true? And so we if somebody's not going to sign a personal guarantee, we can't work with them. Now, if you walk in and you have, let's say that you have 25 million on deposit with your securities broker, okay? They may require to have a certain amount of your securities set into an escrow account and not have you do a personal guarantee. But don't go into an acquisition financing scenario expecting that the bank is taking all the risk and you're not. It's just not happening in 2020. And then expect to meet with your financing partner regularly. That's really important. Again, I'll go back to what I said earlier. Even if the news isn't good, you don't want to wait until the bank calls you to give them the bad news. At that point, now their antennae are up. They're scared. They're nervous. At that point, if you haven't sought them out and said, look, we just want to go through where we are, and we want to show you how we're going to recover, how we're going to make this better. That's the best practice. And oftentimes, now this is not a shill for financial services, but oftentimes if you run into situations where you're, financially struggling a little bit, it's good to have a third party with you that can talk about how we're putting together a financial recovery plan and how we're going to make things better. So that's that. We can go on to the next one. So that was easy. That's what it takes to do acquisition financing. Now there's all different kinds that we haven't covered, but these are the main types. Now what I'll say is we didn't talk much about SBA loans. We talked about SBA loans in an earlier session, and I just want to go into just a couple of things about SBA loans. The SBA gives you an advantage over conventional lending in that they will allow you to put less down. I've seen as little as 10% of the deal put down from an SBA lending. From an SBA perspective, 10%. In fact, one of my more successful deals was a young man that had worked successfully in a president of a division of a large company. He was 40 years old. He didn't have a lot of cash, and we put 10% down on about $1.5 million deal. He was able to build the company, secure some big contracts, and in about 5 years, he was able to flip the company and turn around. He made something along the lines of 15 million net on that because he had hit it big. But the key was being able to secure SBA financing with only 10% down, and that's a big deal. SBA financing will have certain constraints. So in the deal structure conversation, we talked about the SBA piece where you could have a seller note. In an SBA lending environment, the seller may not get payments for 2 years. So the SBA wants to make sure that you're preserving all your cash to pay for them. But there are SBA lenders that are preferred lenders, and those preferred lenders don't need to submit the paperwork in advance to the SBA for approval. The preferred lenders are all the big guys are typically preferred lenders. Those are the sources to go to. Okay, what are good sources for board members? So interestingly, we tend to think of board members as being people from within our industry, but what a combination of board members from inside the industry as well as outside the industry is usually pretty good. You want to have people that have a multidisciplined approach on your board. I can think of examples where we brought people in from different industries into some of our companies for advisory boards, and they look at it from a whole different perspective than the industry insiders. Once we're inside of an industry, we all tend to see the same stuff and go to the same conferences. So it's interesting to have people from other industries on your board as well as insiders. A recommended advisory board, yeah, we typically think of having somebody, we'd like to think we could have somebody that's, you think of the food chain, a customer, a vendor, somebody else that's an independent third party. You typically don't want to put your attorney, you don't want to put your attorney, your accountant, or anybody else that you're already paying on your board, because you already have the benefit of their advice. You want people that come from outside who will help generate new thinking. I'll give you an example of a board. I worked for an energy services company, and what we were looking to do was to build a bigger book of business within the the companies we work for. And we work for a big power company. So the retired CEO of one of the big power companies in the region, we put him on our board. Well, he unlocked doors for us into customers that we had had a very, very difficult time getting into. So he had relationships that extended far beyond us. If we had had a board member who was a retired executive of our company, or somebody else who was in a competitor to us on our board, it doesn't help us. It doesn't create a bigger pot. And looking at different types of loans, which are the better ones and why? Well, to me, if you can go conventional funding, that's the best way to go. Conventional funding, typically more lenient with the restrictions and covenants, are typically lower cost, and they're easier to push through. SBA loans take longer, and can be a lot more administratively taxing, and they're more expensive. What's interesting is, as far as the pandemic goes, banks are looking to lend money right now. Banks are a little bit nervous like the rest of us, but if you're doing conservative forecasting, reasonably conservative, not forecasting that is crazy conservative. Oh, this is the worst case scenario. We're going to hit 40% of that. If whatever your business is tracking to now, if you say we're going to continue to run it at this percent to 2019 numbers, but we're going to grow it a little bit just with inflation and ordinary growth, that should be a reasonable way to get money. Banks are lending. I was reading an article just yesterday that the lending environment continues to be pretty good. It's industry by industry. Of course, you have to be pretty smart about it. The restaurant industry is getting murdered right now for obvious reasons, but there are other industries doing great. And in fact, I was reading this morning, we subscribe to GF Data, which is a big data research house that collects actual deals. And they said deals are running at about 80% of the volume they were last year at this time. So the deal environment's still fairly fertile. And so that means lenders are still lending. Has the pandemic affected the availability of equity investors? And equity investors are rabid right now. Equity investors are just looking for deals. This is a tough time to be an equity investor, because there's a lot of private equity money out there looking for deals, and they were looking for deals in the pre-COVID days. Now with the number of deals and the strain on the system, if only 80% of those deals are available now for various reasons, the equity investors are really, really hungry. So if you're in the market for an equity investor, now's the time to look for them. What are expected board fees? Now that is all over the place. What I would say is, for a true board, a real board that has a legal board that has legal accountability to shareholders, fees could range anywhere from $5,000 to $20,000 a meeting, a quarter, because there's legal liability, and they set CEO compensation and other important things like lending parameters, borrowing parameters, dividend policy. So that can be extensive. In small companies, to look at advisory boards, which is another route, and we've actually set up and hosted advisory boards for small client companies. It's not uncommon to see fees of $500 to $2,000 per quarter. It's just, there's not a very strong legal accountability of an advisory board to the company. I mean, there could be certain things arise, but advisory boards are easier to put together. They're not as formal. They don't have really any accountability to the shareholders. So I would say $500 to $2,000 per meeting per quarter. So are there any industries we would not recommend trying to sell a company in this environment? Well, actually, I just said it earlier. I was called 2 days ago by a money manager, and one of their clients is in the restaurant business. And it's a terrible time. And I would say, if your business is down and you have a wherewithal to sustain it for the next 12 months, don't sell it. I would say you're selling low instead of getting the company to recover. What I would suggest, and so for the companies that we're talking to that are very, very hard hit by COVID, we're helping work on recovery plans for them so that they can get back to a steady state, even if that steady state is only 75% of what 2019 was. But selling at your worst, at your lowest, if you can avoid it, avoid it. What we would recommend is try to recapitalize your existing indebtedness and try to see if you can win favor with an equity investor or a bank to carry you through. Besides legal liability, what is the difference between a board of directors? Essentially, advisory boards tend to be coaches and tend to be thought provokers to the management team, whereas board of directors are legally appointed ambassadors of the shareholders who are overseeing the senior management team, and they appoint the CEO, they appoint the C-level executives, they set salary, they set other parameters around which the company operates. So those are some of the differences. I think it's a size issue. At what point should you consider switching to a board of directors? I think it comes down to size. You know, if your company has reached a point where you feel like it's big enough that the CEO's competencies can't cover all aspects of the business. And now that's a very significant judgment that needs to be made. But it's not uncommon where I would say where a company reaches a point where you have, you know, a full-fledged VP of sales, VP of marketing, VP of operations, VP of distribution, VP of IT, VP of finance and accounting. You have all these, you have a C-level suite, and there's you know, high growth in the company. A board of directors may be able to instill a sense of stability and a sense of calmness and a sense of security to the shareholders, because very often in small companies, CEOs can wield such power that it can be, after a certain point, to the detriment of the other shareholders. And so when a company gets to a certain size, and it's, I would say, you know, at about 50 million in revenue is to me, that's a typical jumping off point where an advisory board becomes less helpful and a true board of directors becomes important. So we're at about 57 minutes, and we've covered the topic I wanted to cover. Are there any other questions before we finish? Okay, so I hope you found this helpful. Like always, we'll put this on our site. If you have any questions, feel free to reach out to me directly. I'm happy to answer any specific questions you may have. And next week, we're going to talk about the due diligence process and the things you need to do to make sure that you're getting what you think you're getting in the construct of an acquisition. Appreciate your time, appreciate your interest. Again, happy to assist anybody who wants to talk further about any of this. We're not here to charge you for our hourly fees. What we're here to do is to impart knowledge. And if down the road you decide you want to do an acquisition, hopefully this is helpful to you and you have information that will help you be more effective at going at it. So with that, I would say thank you for your time and attention, and we'll see you next week.